Welcome to the Chapter 9 mini lecture on the foreign exchange market. Now, as you probably know at this point in the course, I usually will cover only some fundamental principle in each chapter without a thorough review of the text. This time, I'm making an exception. I'm trying to get everyone caught up in the class, and in support of that mission, I'm providing you a full lecture on both chapters 9 and 10. Now, although it is still a good idea for you to read the textbook, this particular lecture will be more intensive and more detailed than the other lectures provided in past chapters. So, let's start off with a basic introduction to the activities that occur in the foreign exchange markets. One of the major activities in the foreign exchange market is to provide a venue where export receipts can be converted into other currencies. And if you think about it, it makes sense. After all, when a company sells their goods to a buyer in a foreign market, they do not want to be paid in the foreign currency. And in order to purchase that product, the buyer in the foreign country must request US dollars. And these activities occur in the foreign exchange market. Once the buyer in the foreign country obtains dollars, he can arrange to pay for his purchase. Now, the other option in this scenario would be that the foreign buyer would pay the U.S. company in the foreign currency, and then the U.S. company would take the foreign currency to the exchange market and exchange it for U.S. dollars. Regardless of who does it, the currency must be converted in order for the U.S. company to deposit U.S. dollars. Now let's think about another possibility. Let's say that you invested in a company overseas. If the company is providing a dividend to you, it is highly likely that they're going to pay you in their own currency. And once you receive that, you want to be able to convert it over to US dollars so you can spend it here in the United States. And then activities such as the conversion of investment income occurs in the foreign exchange market. If there is an agreement in place, whether it is a joint venture agreement or a licensing agreement or any other type of agreement in which monies change hands, those monies are exchanged in the foreign exchange market. The contract is going to provide for an acceptable currency that's authorized for use under the contract. So this also works in reverse. If we are buying product from another country, they may not be interested in receiving US dollars. They may want their own currency and might expect payment in their own currency. Now, certainly this next activity we're going to speak of is not for the faint of heart, but if you decided that you have plenty of investments in US dollars and you wanted to invest short term in other money markets, you would want to invest in the currency of the money market. And of course, you can always give currency speculation a try, and that basically means that you're going to make short term movements in the market, changing from one type of currency to another in hopes of making money on the differences in the exchange rates. So the foreign exchange market can also be manipulated to provide some protection to companies against foreign exchange risk. Now, for those of you who have not taken international accounting, let me give you a brief explanation of how one type of exchange risk could occur. Let's say that ABC Company operates both in the United States and in Japan. Now, using the Oanda currency converter, let's say that on February 5th, the Japanese office sent $1,000 to the U.S. office. The U.S. office would receive $10.46. Now let's take this a step further and say that the Japanese office wants their money back on February 27th. So the U.S. office is going to send the money back to Japan on February 27th. On February 27th, unfortunately, on the return trip, the Japanese office will only receive back $963.17. not the full $1,000. You can see in this example that the mere converting of the currency from yen to dollar and back to yen resulted in a pretty significant loss in value. And this is an example of a foreign exchange risk that a company takes when they convert currencies. A firm can protect itself from the foreign exchange rates by hedging. And in basic language, hedging is taking a position in one market to offset a loss in another market. And in the foreign exchange markets, firms can make use of spot exchange rates, forward rates, and currency swaps in order to create a hedge. Now, the spot exchange rate is the rate at which it's the rate at which a foreign exchange dealer converts one currency into another on a particular day. And it's pretty easy to find out what the spot rates actually are on any given day. Let's go back to the OANDA website. Now, this link, if we go to OANDA and we click on this live exchange rate, the market is closed today, so it is not reporting the updates. But this screen will update every 5 seconds, and it will put red arrows and green arrows in every update so that you can see which currency relationships are dropping in value or depreciating, and which currency relationships are appreciating or increasing in value. Now, I'm going to scroll down to the bottom of the screen and read you a paragraph. The live rates on this page are updated every 5 seconds, but note that real-time rates used by currency traders are updated more frequently. So even though this website updates every 5 seconds, the currency traders are updating in milliseconds. OANDA is electronically connected to numerous global banks to access the best foreign exchange rates for its traders, and electronic algorithms on OANDA's foreign trade servers update forex rates tick by tick in periods of less than a second. So what that is basically saying is that now their banks are closed overseas, so that's why we're not getting the 5-second update. But basically what they're saying is we're using the banks to form these relationships between the bid and the asking price. But when you actually go to convert your currency, there's going to be some differences in the final rate that you'll pay, because even as you're approaching the international bank to exchange your currency, those currency relationships, those values are changing. Okay, now we've looked at the spot exchange rate, which is the current conversion price from one currency to another. Now, a forward exchange rate is basically the exchange rate governing a forward exchange, and a forward exchange occurs when you have two people that have agreed to exchange two different currencies at some date in the future. The reason that this works to the advantage of the people that are in this that are using this forward exchange rate is that they agree on the exchange rate price today, and this prevents both sides from assuming a lot of risk, especially in converting currency where there's a high degree of fluctuation. Sometimes companies and banks and even governments will engage in a currency swap, and the currency swap is the simultaneous purchase and sale of a given amount of foreign exchange at two different value dates. So let's go back and look at ABC Company again. Let's suppose that the U.S. company needs to acquire Japanese yen and the Japanese company needs to acquire US dollars. Now, these two offices could arrange to swap currencies by establishing an interest rate and agreed upon amounts along with a common maturity date for the exchange. Now, the currency swap maturities are negotiable for at least 10 years, making them a very flexible vehicle of foreign exchanges. Currency swaps are usually used to get around exchange controls that are established by the foreign government. It is not difficult to recognize how complex the foreign exchange market is, and since the foreign exchange market includes banks, brokers, and foreign exchange dealers from all around the world, they have to be connected electronically, and most of the communications occur electronically. There is always a foreign exchange market open at any given time, no matter what the hour. We are not going to go into the complex discussion on arbitrage, but it is important that you understand what arbitrage is. If you have exchange rates that are quoted differently in two or more markets around the world, there is an opportunity for arbitrage. So that means that, let's say you could buy Japanese yen on the German market at a lower price than what you could buy it for in the Spanish market. Technically, you could buy yen at the lower price in Germany and sell it at a profit in the Spanish market at the higher price. And those types of opportunities are called arbitrage opportunities. Now, in reality, it is very difficult to spot arbitrage opportunities now, mostly because of the rapid processing of investment orders. With supercomputers calculating perpetually, any window to buy low in one market and sell high in another market may only be in existence for a microsecond. So there are a couple of rules to apply when looking at prices relative to exchange rates. Now let's first talk about the law of one price. This is a business concept. The law of one price basically states that in competitive markets where there are no transportation costs, no barriers to trade, and the products are absolutely identical in different countries, the price should be the same after you convert from one currency to another. The second law is known as the purchasing power parity. And to make this as simple as possible, let me explain it like this. If we buy a bar of soap here in the United States, and then we take the same amount of money, convert it over to another currency, and buy the same bar of soap in another country, the price should be the same. If it is not, then one of the currencies is either overvalued or undervalued. Now, if we just look at the law of purchasing power parity, we have to accept that if there are changes in the relative prices between countries, it's probably because of inflation. If inflation is pretty high, then the currency should depreciate or drop in value. If that is true, then we can also predict how our currency value might change depending upon how the inflation rate changes. If we know that a country's money supply is expanding, then there's a very high probability that there will be inflation. Now, we cannot say that purchasing power parity is accurate in the short term, but when you look at things over the long term, purchasing power parity is pretty accurate in that venue. If we use purchasing power parity to predict future inflation rates, this fits comfortably in our next topic, which is the introduction to the Fisher effect, and that explains nominal interest rates. Now, the book represents the Fisher effect and defines it basically as a function that states that a country's nominal interest rate is the sum of the required real rate of interest and the expected rate of inflation over a period for which the funds are to be lent. Now, that sounds like a complicated paragraph. Now, in this slide presentation, if I created any additional slides, those slides are appearing in blue. That's why they look different. These slides are slides that I made to further explain this Fisher effect. So let's look at some basic definitions here. Inflation is a general increase in price levels. Your money buys less because prices are higher. And deflation is a general decrease in price levels, but your money buys more because the prices are lower. And when I'm talking about price levels, I'm talking about how much product $1 basically buys. Okay? So to determine the nominal interest rate, which is the named interest rate that's posted at the bank. This is the interest rate when you walk in and you open a savings account and it says, our savings account pays this much interest. That is the nominal rate. So to determine the nominal rate, which is the named interest rate in the market, we simply add together the real interest rate plus the change in the current price level. Now, the book only talks about inflation, but a country could also experience deflation. But whether or not we're talking about inflation or deflation, it is still reflected as a change in the current price levels. And if we make the assumption that the real interest rates are consistent from country to country, then the difference between the nominal interest rates would have to be the inflation rate. In fact, if we know any two elements, we will be able to calculate the third. And this is basically the domestic Fisher effect. So in order to wrap this up, let's go back and look at the formula one more time from the perspective of the investor. Okay? And the investor cares about the real interest rate. Okay? If the nominal interest rate is 6%, and remember that is the interest rate that is posted at the bank, and that is also the amount you are earning in your savings account, the 6%. And the inflation rate is 4%. Your real interest rate is 2%. During inflation, what you really make is less. If the nominal interest rate is 6% and deflation is 4%, your real interest rate is 10%. Because during deflation, your money buys more. Now we'll look at the international Fisher effect as defined by the book. Now the international Fisher effect suggests that for any two countries, the spot exchange rate should change in an equal amount, but in an opposite direction to the difference in nominal interest rates between the two countries. Okay, let's break this down. Before we discuss the international Fisher effect, let's revisit some definitions. The spot rate is the value of the currency in terms of another currency. We will also use the phrase equal and opposite, so consider that a value itself is changing in an equal and opposite amount. So as an example, a $4 or 4% increase in something will result in a $4 or 4% decrease in something else. And that is what we mean by equal and opposite. So let me emphasize one point regarding the international Fisher effect. The theory predicts nothing. All it does is explain present and future spot price movements. It does not prove to be true in the short run, but it does prove to be true in the long run. So the concept behind the international Fisher effect is rather simple, even though that paragraph sounds a lot more complicated than what it truly is. The change in the spot rates between the two countries should change in an equal and opposite direction as the difference between the nominal rates between the two countries. So let's look at the example. If companies, and this is at the bottom, this was copied from Investopedia, if country A's interest rate is 10%, and country B's interest rate is 5%. Country B's currency should appreciate roughly 5% compared to country A's currency. So let's take this comparison step by step. First, you have to select the country which will provide your basis for comparison. Now in the previous example, the basis was country A's interest rate at 10%. Country B's interest rate dropped to 5%. So that is represented as a 5% drop or negative 5%. Now if we apply the international Fisher effect, company B's currencies will move in an equal and opposite direction, meaning the currency will appreciate against country A in the amount of 5%. So remember that the international Fisher effect does not predict spot currency rates. It only explains the movement. Excuse me. So there are other things that have an impact on exchange rates, and one is called the bandwagon effect. And this basically occurs when the expectations on the part of the currency traders turn into a self-fulfilling prophecy. One group of traders will start to act in a certain direction on the market, and then other groups join in those actions based on their group expectations. So after reviewing the possible impacts on future exchange rates, a business owner might feel that it's necessary to retain the services of an analyst to help make decisions about future currency prices. Now, whether or not you think that this is a good idea is dependent upon whether or not you believe the markets are efficient. If you believe that the markets are efficient, then you would believe that the forward exchange rates are unbiased predictors of future spot prices. Then if you believe that the markets are efficient and that the forward exchange rates are unbiased predictors of future spot prices, you would believe that the analyst would be a waste of money. Now, if you believe that the market is inefficient, that means you would also believe that the prices do not reflect all available information and that there are additional opportunities and variables impacting the future spot exchange rates. In that case, you would believe that the services of an analyst would be well worth the money. If you believe that you can forecast for future currency spot rates, you will probably use one of two available approaches to forecasting those rates. The first technique is called a fundamental analysis, and it basically draws upon economic factors like interest rates, monetary policy, inflation rates, and the balance of payments to predict exchange rates. And if you work if you were to work to complete a technical analysis, you would basically be looking at past trends and assessing whether or not those past trends are predictors of future behavior in the markets. So all the forecasting techniques available that can help you predict the future spot prices of currency will not help you if there's a convertibility issue. A currency that is freely convertible is one in which the residents of the country and the non-residents of the country can purchase unlimited amounts of the currency with their own money. A currency that is externally convertible means only non-residents can convert their holdings. And of course, the currency that is non-convertible means both the residents and non-residents are prohibited from converting their holdings. Now, why would a country limit the convertibility of their currency? I mean, many countries will limit the convertibility of their currency in order to prevent capital flight. And capital flight basically occurs when people attempt to sell off large amounts of the currency that they have for a more favorable currency. And when the government decides to limit the convertibility of the currency, the side effect can mean that a counter trade economy starts to develop. And that basically means that the businesses start to barter with their goods and services and trade them for other goods and services to facilitate international trade. There are three types of exchange rate exposures that can have an impact on business. First, there is a transaction exposure. And when a transaction exposure occurs, there can actually be a monetary loss on an individual transaction due to a significant change in exchange rates. Another type of exchange rate risk is a translation exposure, and that occurs when the impact of fluctuating currency values reflects negatively on the financial statements of a company. And to give you an example, or try to clarify this, let's think about a transaction or a sale that occurred last year in a company. If we use the currency rates to assess the value of that purchased or sold asset today, there's a possibility that because of a change in the relationship between the two currencies, that it might have been a positive entry on the financial statements last year, but this year it has a negative impact. And the third type of exchange rate risk is an economic exposure. And the economic exposure means that the international earning power is impacted by the changes in the exchange rates. Now, the management of all three of these types of risks can have a significant impact on the decisions made by the business unit. And when firms are confronted with transaction and translation risks, management may decide to purchase currencies on a forward contract or arrange currency swaps or manipulate how their payables and receivables are paid to take advantage of predicted currency value fluctuations. And this type of manipulation is called, or these two types of manipulation are called lead and lag strategies. So if a company thinks that their currency is going to appreciate, they may delay the collection of accounts receivable because they want the money that they receive to be worth more. So if they think the value of the currency is going to be worth more next week, then they're going to put off collecting money from their customers. On the opposite side of the table, the accounts payable, if they think that the money is going to appreciate in value next week, they're going to want to pay their accounts payable with cheaper dollars, today's dollars. So they're going to, this is just a basic chart that sets up what the lead and lag strategies would be in the case of appreciation. In the case of depreciation or a drop in the currency value, the company is going to attempt to immediately collect their accounts receivable. Now think about that. If you think that the currency is going to fall in value, you want your money now because it's going to be worth more. So you're going to attempt to collect from the companies and the businesses and the people that owe you money. You want your money today. So you're going to attempt to collect, and then you're going to delay paying your accounts payable because you want to be able to pay your bills with a cheaper currency. So these two slides explain the difference between the lead and the lag strategies based upon whether or not management thinks that the currency is going to appreciate or depreciate. Now, the easiest way to manage economic risk is to distribute assets in the countries where the currency values are the most stable. And this also makes sense. If you do not want assets that you have, whether they're physical assets or investment assets or facilities, if you do not want those assets to be negatively impacted by huge fluctuations in currency rates, then you're going to put those assets in countries where those fluctuations do not occur. So the more stable the currency exchange rate is, then the more favorable the investment climate is for that country. So as in every other area of risk that management must address, companies should have established financial management policies in place that maintain a centralized control over the assets. And other tactics to manage foreign exchange risk include properly classifying risks, whether they're transaction or translation or economic, and attempting to predict future exchange rates. And go ahead and try to predict those future exchange rates. And companies should have a good reporting system that reports timely on exchange rate exposures.